in 2006, I started to stockpile liquidity, and looking at the situation, I was quite worried. The leverage, if you may not remember this, but the leverage, because of accounting rules and Basel III, Basel I, investment banks, particularly the banks, the big investment banks, went from 12 times leverage to 35 times leverage. And it was go-go.
So for every $1
CMOs,
I'm putting in,
bridge loans, the whole thing. Like in 2007, the bridge book of Wall Street was $450 billion. Today, it's $40 billion. JP Morgan can handle the whole $40 billion today, though we're not the $40 billion today. And they were much more leveraged deals. And a lot of them fell apart, collapsed, and then of course, and that was before you had the collapse in the mortgage markets, which really took down a lot of these banks.
But you did have the same incentives, and you had the same access to information that a lot of these other folks did, but you didn't blow up. What explains this? Because usually behavior follows incentives.
Yeah, well, first of all, if you work for me, I would tell you, I don't care what the incentive is, don't do the wrong thing. And don't do the wrong thing to the client. If you treat yourself, if you're the client, how would you want to be treated? And I had gotten rid of, I mentioned that one risk thing, there were multiple risk things like that. They were being paid to take the risk. So
you were telling us about the auto loan business.
Yeah, but they were being paid, but the second I put in all these new risk controls, all of a sudden you weren't making money by taking that leverage, because I was looking at how much capital can actually be deployed if things get bad. And so I was looking at earnings through the cycle. But very importantly, all of these investment banks were doing side deals, private deals, 3-year deals, 5-year deals. I got rid of almost all of them.
This is for comp
almost all
with
of
senior
them.
bankers.
And so today at JP Morgan Chase, there are no, we do things, and I know some of my partners in the room here, but we all know about it. There are no winks, there are no nods, there are no side deals. There's almost no one paid on a particular thing, because if you're paid on a particular thing, you can do the wrong thing. And meanwhile, you're not helping the company, manage its risk or something like that. So we changed the incentive programs, and I'm quite conscious about incentive programs that they don't create misbehavior. But it's also very important, if you're in a company and you say the incentive program is doing that, you should tell the company this incentive plan is not incenting the right behavior versus the customer. And a lot of it was leverage. So if you look at the leverage in some of these securitization books and mortgage books, if you have 30 times leverage, and you're getting 20% of the profits, you'll go to 40 times leverage. It's literally add 25% to your bonus. And so I got rid of the profit pool of 20% and the leverage.
So yeah,
and I lost some people too in the meantime.
It's funny, yeah. JP Morgan as part of the system had the same incentives, but you changed the incentives for
pretty much.
The team within the company. Okay. All right, we got to go to 2008. March 13th?
2008.
Thursday, 2008.
Yeah.
It's Thursday night. You get a call from Bear Stearns' CEO. The stock closed that day at $57 a share. It's like $150 a couple months before. 3 days later, God, I remember it like yesterday. I was working on Park Avenue on Wall Street. I remember that night, $2 a share. You're buying Bear Stearns. Tell us the story.
So I was at Avra on 47th Street with my parents in my parents' favorite restaurant. My whole family was there. It happened to be my birthday. I don't normally get emergency
Happy
phone.
birthday.
Yeah. And Alan Schwartz, who was the current CEO, we'd seen their stock go down. I knew they had some real problems because we saw their hedge funds and some of the things that were taking place there. And he said, Jamie, I need $30 billion tonight before Asia opens. To which I said, I don't know how to get $30 billion for you. And have you called Paulson? Have you called Tim Geithner? So we all called. I called up the management team. I went back in. I probably had a bite and said goodbye. I went back to the office. Probably had 100 people come in that night. They all got dressed. They went back to work. It's emergency. We now rang all bells for emergency. Bear Stearns went bankrupt. Spoke to the Fed about, let's just get them to the weekend. We had one day, and we needed a Saturday and Sunday, and we concocted this loan. So we couldn't lend the $30 billion, and the Fed technically couldn't lend the $30 billion, but the Fed can lend to us technically, and I can technically use the collateral of Bear Stearns so that, so we got the literally one-day loan. And then the next day we had thousands of people come in due diligence, and we went through every loan, every asset, every balance sheet, all the derivatives, all the lawsuits, all the HR policies, like real due diligence in a 2 or 3 day period, and bought the company at that night $2 a share. Hank Paulson was saying, why are you paying anything for it? I said, well, I do have to get shareholder votes. and which became.
Right, because you need Bear shareholders to approve the deal.
It was a public deal, and the worst part of it is I was going to get the lawsuits from the Bear holders, and I knew that.
That you didn't pay enough for
But we couldn't let it go bankrupt. It wasn't like an industrial company can buy it in bankruptcy. It would have been gone, and the crisis would have just unfolded. So,
Okay, 2 questions. One, what would have happened if it went down? 2, afterwards, did you think it was over?
no. So we already had. So that was March. What happened with Lehman? It was an uncontrolled failure. There was money locked up everywhere. People panicked. They started pulling money out of everything. That would have happened with Bear. So it did stop that, and I would have thought that it gave other people other time to clean up their act. So literally 6 months later, I would have thought some of these other firms had more liquidity, more capital, and were a little bit more prepared for what might be happening. We already had the stress in the system. You saw it already. It was going to mount. It wasn't going to go away. There were tremendous losses coming. So we bought it, and probably did help. In hindsight, it didn't stop. It didn't stop the crisis from unfolding. We bought it, and then like a week later, we changed to $10 a share. It had been at $120, and the way to think of it is, it was $300 billion of assets. It had a $12 billion tangible book value. We wrote off the whole tangible book value when we bought the company to pay. We had to liquidate the loans. We had to hedge stuff. We had severance costs, lawsuit costs, and we basically used all that. So we paid $1 billion for a company that had been worth $20 billion recently. The building we're in now was worth $1 billion on the balance sheet for zero. And we got the fact we got some very good people, and we got some good businesses, but it was an extremely painful process.
I've seen estimates that in the fullness of time, after really dealing with unwinding all the stuff there, it cost you $15 to $20 billion.
So it cost you 20 anyway.
Cheap.
Yeah.
It was the $12 billion we wrote off. That didn't cost us. We didn't really pay for it. And then the government sued us on the mortgages, which I was quite offended by. And I really was. I thought it was.
Take this problem, and then we'll sue you.
This is the government. When whatever government you did a deal with, that's not the government down the road who decides, I don't care, we're going to come after you anyway. So while we kind of saved the system a lot, we bailed a lot of people out, they made us pay $5 billion on the bad mortgages that Bear Stearns had done. And that's what made me make the statement I wouldn't do it again. I wouldn't, put it this way, I don't know how to say this, I wouldn't really trust the government again. Okay?
I gotta ask a follow-up question to that. Is that a structural thing? Just the way that we're set up with a new administration every 4 years?
Yeah, they don't feel obligated to what the prior administration did. And, even some contracts were violated in this thing, which I won't go through. Literally contracts. I mean, it would have been tortious interference had it been company to company. But they basically, since you operate under their laws, they can basically take you down. So I went to see Eric Holder trying to settle all this mortgage stuff, which we settled. I brought my lead director. He expected me to come and be pounding my chest. And I went in and said, Eric, I am here to surrender. I cannot fight and I cannot win against the federal government. You know that a criminal indictment can sink my company. I will not do that to my company or my country. I'm here to surrender. Before I surrender, I want you to know the circumstances by which we bought WAMU and Bear Stearns, because 80% of what they were asking for related to Bear Stearns and WAMU, not JP Morgan Chase. And I went through the whole thing. He said, thank you, I'll take it in consideration. But they never gave me the accounting, so I don't know what they did. And so it is what it is. It was quite painful, but got to move on.
We'll move on from this.
We'll move on. We'll move on from the specifics.
David's like,
I do have one more thing. Whether you would have done it again wouldn't have, very clear. It was not a great deal on paper for JP Morgan. But as we look at it now, the reputational value the reputation of JP Morgan now is unlike any other in the industry.
Part of why you're worth $800 billion is that reputation.
Yeah.
A lot of what created that reputation
was that weekend.
Yeah, if you're, yes, and I know I say I wouldn't trust the government. If the government called me up, they did it again, If they called me again and said, we need your help to save our country, well, of course I'm a patriot that way. I would just try to come up with some ways to avoid the punishment by the next president. I would come up with something.
You need like the version of the merger agreement with JP Morgan Chase where it's like a 75% of Congress needs to vote not to sue you. Like, the default is you're not going to get sued.
All right.
So
Bear Stearns happens. 6 months later, you get another phone call. WAMU is going under. You do buy WAMU. Contrary to everything we're talking about with Bearer, WAMU is actually a great acquisition, right?
Yeah. So this is a lesson about acquisitions. It's very hard. Remember, we bought WAMU a week after Lehman went bankrupt. And most boards wouldn't have touched that at all.
Because the whole system feels like it could.
The whole system was in trouble. But WAMU put us in California, parts of Nevada, Georgia, Florida, which we weren't in. So think of these really healthy states. And they had 2,300 branches. They had huge mortgage problems. But we had looked at it over and over and over. So we knew their mortgage books cold. And we wrote off, we bought it
and this was all before...
We bought it for a $30 billion discount to tangible book value because they had debt, and we left the debt behind. And that $30 billion was approximately what the mortgage loss was going to be. So we bought the company, think if we bought a company clean, we wrote off all that stuff, the books were clean, and then we did something unheard of too. The next day or 2 days later, I went in the market and raised another $11 billion of equity, which I didn't really need. But again, this is my conservatism. I was like, you know what? This could get even worse, and I don't want to be short capital liquidity. So we raised that to make sure our balance sheet was just as strong as it was after WAMU that it was before WAMU.
And you already had the reputation to pull this off, right? I'm imagining in the worst month of the financial crisis, who can go out and raise $11 billion of equity?
Yeah. It was,
People trust you.
Well, yeah, we knew a lot of the shareholders, and you earn your trust over time with shareholders, and we explained, we gave them a quick little presentation over the, and a lot of them stepped up and said, this is great. They also know we can execute it because behind the Bear Stearns, people forget the work is the next day you got 50,000 people consolidating 5,000 applications, branches, compensation programs, settlement programs, payment systems,